Hi everyone, welcome to the Digital Fifth Fintech Show. Today we have with us Manish Khera. I will let Manish introduce his company. Over to you, Manish, and thanks for joining us.
Hi Samir, hi everyone. I am Manish Khera. I am founder of Happy. Happy is one of the big digital lending fintech companies in India. We focus on the small businesses, small customers, people at a level where literally it is the proprietor who's running the business. Over the last 3 years that we have been working, we have done more than 5 lakh loans across more than 2 lakh customers with a very small ticket size, our average being around 30,000 rupees. We lend anywhere from 2,000 rupees to 2 lakh rupees. And we specialize, as I said, in a fully digital process to give access to credit to small businesses and expanding very, very rapidly.
Fantastic, fantastic. I think yours is a classical API-based economy structure, right? So can you just quickly tell how exactly this model works? Because you right now work on both sides. So how does it actually get executed?
See, if I in a way step back and say that fintechs in general, or tech in general, I should say, is bridging the gap between what the traditional institutions have been doing and what the customer requires across the entire spectrum of financial services. Even on lending, if you see the data 3 years back, there were just about some 200 million people in the bureau records, while the country had more than a billion bank accounts, which means 80% of the customers had not borrowed from the formal system. And fintechs like us have taken that number in last 3 years itself from 200 to a 500 million number.
Wow.
So that's a big leap for the country. That's a big change that we have seen. And so that's what we have been doing. And on the other hand, also, if you see a very macro trend, banks, NBFCs in India, the traditional institutions, they have been focused more on a security-based lending models, one way or the other. Whether it be in a home loan, loan against property, gold loans, vehicle loans, pickup, whatever the segment. The market, however, especially at a smaller level, changes to more of a cash flow-based analysis market, where either the security is not there or is not attainable, both in terms of logistic costs, etc. So you have to focus on the analysis of the customer, of the cash flows, and again, you can break it up into ability and intention. So what we do is, or maybe let me also call out a third trend which is happening in the market, which is to say that incrementally a lot of businesses are getting digitized and a lot of business cycles are getting digitized. So digital footprint of the customer is available more and more. So what we do is tie up with a set of partners who have a business relationship with these small businesses. That partnership enables us to pick data, digital data of these customers or potential customers to the extent it's available with the partner, and supplement it with the data from the ecosystem, and use our own proprietary algorithm to underwrite this credit and provide credit to them. There's a broad business cycle that we follow, and that's what has enabled us to reach out to a set of customers who were earlier not being serviced by the formal system. As much as 40% of our customers are new to credit. That's what has enabled us to give ticket sizes or loan sizes of this small, 2,000 rupee or 30,000 rupee or 50,000 rupee values, and also disburse and take the repayments digitally, which makes it efficient and convenient for the customer as well, which is reflected in the 65% repeat rate of customers that we have.
Okay, so I think this is given that we are in, right now in a COVID situation, and SMEs are the most hit. Their shops are closed, and physical or non-physical, I think everybody's impacted. And physical classes, the shops are obviously most impacted, which is your biggest segment. So, what trend? What kind of situation you've seen that, and what is the kind of demand you see right now, given the current situation for SMEs?
So right point, Samir, but I would not agree fully, or at least I would say the data doesn't agree fully with what we are saying. So the type of businesses that we are dealing with are very small and right there at the ground level. And as much as 50 to 60% of these businesses are still operational.
Okay.
In fact, some of them have also been declared essential services. Otherwise, also, if you see, they're literally essential for us to carry on our day-to-day lives. And in fact, these are the people, the neighborhood grocer, the neighborhood restaurant, the neighborhood, shops, which are making sure that we all are able to stay home safely, even in this period. That's our typical customer. So as the COVID information started coming in, and as we started realizing that market is going to go into a shock because of this, the first thing we did was had our internal estimates of what is going to happen. Then we went to some 20 plus partners with whom we work and took their feedback on what they are going to see in the market and what are they expecting. We also spoke to some 300 plus customers of ours and understood what they are going through and how they would want us to support them in this time of crisis. Based on all this feedback, in the first week of April itself, we came up with our new product called the Lockdown Loan, where we are supporting our customers and making sure that they get credit in this time of need. We have also bundled insurance with that, COVID insurance particularly, so that if they do catch the virus, the loan is paid by the insurance. So this is the product we have taken to the market. We have already done 100 plus loans, and we are scaling that very rapidly.
I think I fair point. This is interesting and maybe very different from how others are approaching. I've seen so many of them stopping completely the entire lending cycle. So disbursement is not happening. And obviously, because of moratorium, collections is not possible. So key point here is that, Manish, you have attempted something completely new and maybe going against the whole way which is going on the lending side. So how do you see the impact on the collection side? Do you see that given that the way you are underwriting, do you see collections will still not be an issue, given that some of them are a bit impacted for sure?
So we are seeing, you can say, two different type of behavior, and in line with what is the ground situation, you can say. So if you ask me the two fundamental things which are basic to assessment of credit on ability and intention, I don't think either of them has changed because of this COVID cycle. As I said, 50 to 60% of points are still operational. To that extent, their ability has not changed, so they are paying us. The other 40%, where if the shop or outlet is closed because of lockdown, or also there are specific situations now where a particular geography there are hotspots, and while that city may be operational, those hotspots will not be operational. So linked to that, of course, repayments are not happening, and rightly so. Like Reserve Bank has also guided, this is the time for us to give a moratorium to the customer, because this is an externality. This is not in the control of the customer, and we have to support the customer in this window so that when they come back, everything goes back to normal for them, for their lives. And as I said, the kind of customers we work for, they are literally essential services for the society to operate. So we are supporting them, and they will come back once this crisis is behind us.
Fantastic. And so coming back as a founder, I'm sure when you suddenly see a sudden change in the market, things are not moving as fast as you had planned. And many of us had done some more projections maybe around January, February, and all of them were like really aggressive. Now, how do you come back? So what would be the advice you will have for founders which have been obviously impacted? And I still see some of them very dejected and talking a bit negative. What should the founders focus on this current situation?
Okay, so I shouldn't say so, but for us, by way of design, the business was right from beginning entirely digital.
Mm-hmm.
So we have no field force, not on the sales and not on the collections,
mm-hmm.
right? So that's how we run our business. Now, being digital, we have been able to maintain the pace of our business even in this lockdown. Everybody is working from home, and in fact, we are working more than what we were working earlier. So to that extent, there has not been any disruption. There is no field force to take care of. So many of I'm seeing in the fintech world, there are cost cuts being planned, and sometimes layoffs are being planned, because field nothing is happening. And that's in a way a dead cost, which is there. Now, in that regard, I think, for good or bad reasons, is justifiable. As a founder, as somebody running that setup, I'm sure everybody is under that cash flow pressure and is taking those steps. We fortunately have not had to take those pains uh, there, but um, and those pains. I should also say, despite us not being an investor-funded company, it's a bootstrap venture. All the capital is our own, and still, because we already had a very optimized cost structures, we have not had to pass any pain to anybody in the company. So, but yes, people are having to do that, and rightly so. They also have to safeguard their businesses. I was hoping that we or fintechs or small business, we are also finally, all of us are also small businesses in our sense, would get more support from the ecosystem. I think the policy framework has shown the intent, but that intent has as yet not translated into actual support flowing to smaller businesses. The gap is too long and too big. And one of the big things, if I can say, also is that that gap or time lag is happening between what the policy wants to implement by way of support to the businesses, including, I would say, closer home, the TLTRO scheme that government has announced. SIDBI has some schemes. Mudra always had schemes. But the channel of execution continues to be the traditional physical channel. And because they are taking that approach, it's taking time. And in fact, the best recommendation or route I can think of is fintechs themselves. Because fundamentally, all fintechs, wherever, whichever segment they work, are bringing in process efficiencies and declining or decreasing the time lag between the customer wanting money and the money being available. I would have thought that our policymakers would, and I think they should, use the fintech as a channel to get this money in the hands of small businesses, including fintechs themselves, because they are the bridge today between the intent of the policymakers to give credit to the small businesses and the small businesses who need money. Because this is a working capital issue. Everybody is going to face it, irrespective of who you are, small, big, whichever way, because this is a 3 to 4 month disruption, and it has been made worse with the physical disruption which has happened, not just on the health side, but the whole supply chain everywhere, because physically everybody has paused wherever they were. It will take time to come back, and it is a 3 to 4 month working capital issue. And we are still as yet caught up in estimating and delivering through the physical channels. So that's where things are, and hopefully it will get sorted soon.
I hope so. So maybe at this time the question would be more from an employee's perspective. What should employees do? Because some of them are under risk of either getting fired or maybe redeployment in a new role. So what would be your advice to employees? What should they do at this point?
See, all employees, my guess, wherever they are, currently would be aligned or working on their own company's interests and supporting that, making sure that those businesses are able to withstand the shock. I think it is time for employees also to slightly become open-minded and say that, let me appreciate the problem my employer has today. Because as much as it is an externality for the employee, it's an externality for the employer as well.
Agreed.
And I would want, if anytime I have to take those tough calls, instead of laying off anybody, I would want to say that maybe I should lower everybody's salary by some X%. And if nothing else, our PM and MPs have led the way by saying that we will all take 70% of the salary, right? And in a way, the pain is distributed all across. This is the kind of openness or approach I would say that employees should have with the employer, to say that yes, we know there's an externality, we will work, we will support this, and this is what we can do to help you tide over. And yes, for sure, in the process of working from home, I'm sure everybody, including us, we have realized how much of wasteful expenditure we were doing on these sites, which for sure takes top priority in the line to be taken out even before a pain can be passed to somebody else. Those wasteful expenditures have to go, and maybe the bigger setups will have more an issue there, but bigger setups tend to have a lot of entitlements uh, for employees, and employees I think should be now ready to give up those entitlements.
No, I agree. I agree, because if there is an impact to top line, I think bottom line also has to be, I mean,
Yeah,
taken care of. I mean, you can't have a revenue issue and no cost issue, right? Cost has
yeah,
to adjust to it. I think all of us have done it, and maybe it's time to go. I like your model. Go full digital in the process itself. So wherever required, I was reading one of the entities' balance sheet, and number of thousands of crores spent purely on rentals and all is not funny. So I think amount of sort of, I would say, error which we make. I was reading that TCS is going to make 75% of its employees working from home, and maybe we'll not have a deluge of people coming to Mumbai for job, or maybe to Bangalore for a job. They can actually do the job from their own location. I think things will change dramatically. I mean, how would you paint a picture of future after, let's say, 2 or 3 years, once the things settle down? Do you see a permanent impact of that?
see, for sure, it may not be as much as, like you said, TCS is saying 70%, because many businesses, especially manufacturing, agriculture based businesses, processing based businesses, you do require a set of operating environment tools where people have to converge
Of
to
course,
be able to do that business. This call is easier in the services environment,
correct.
um, and services for sure will take that call. And the call will no longer depend on, because earlier it was more of employee convenience, if you ask me. And we had also taken those calls for our employees. People used to travel 2 hours to come to office and seemed complete waste of their time. And we used to give people an option to work from home if they want to. Now I think that call will be taken also for cost reasons. And people earlier were working literally in the gig economy based on their own convenience or choice. But the gig economy kind of a working environment, I think, will become a norm. And employees, more responsibility will be passed on to the employees to say that you create the productive work environment in your homes. You figure out what makes you more productive. We will monitor you more using digital tools, working offline, or rather not on the physical location. So companies, as usual, will figure out their own choices, pass on more responsibility to the employees, and make them more accountable for their time, and in the process also saving cost. So yes, for sure, services industry will see that. And again, if you bring it back closer home, right, fintechs. People have often debated, is this fintech or tech fin? Right? Same way people have debated that banking will stay, banks will disappear. That's what fintechs are going to do. And people have debated saying, will banks collaborate with fintechs, take over fintechs, or will fintechs take over banks, etc., etc., etc. So closer home, I see no reason for fintechs to become stronger than the traditional institutions, whether banks or non-banks in India, because the fintechs don't carry the baggage of physical infrastructure and big employee base
I agree.
and processes, systems which were cutting edge 10 years back. No longer. Earlier, the definition of digitization was setting up a call center and reducing the staff in branches. Now, the definition of digitization is to set a chatbot and not have a call center. So that's so fintechs have a head start for sure. They will this journey which they've started, they will get accelerated far more.
I totally agree. I think digital movement has, I mean, the movement for fintechs have come now. I think in next 2 years, my gut feel says that much more investment will happen in this segment, and partnership will also happen. So a lot of them will grow. It's like Demon ka, this thing is a bop of Demon, right? It's
Yeah,
everything like digital, not just payment, but everything.
yeah.
I think this is great. Any last few words for the audience, and then we can close.
Yeah, the only thing I would want to add, one was, as I was saying, I do hope the policymakers do see this as an opportunity to leverage fintechs to take credit to the masses, whether that be on the business side or on the customer side. Policy intent is there, but the action or the intent is not translated to action as yet. The action is slow.
Okay.
Second, I would say, you know, the making money available and leaving it to a traditional channel of banks or NBFCs who say they will figure out may not be the right answer for doing things faster. Our markets work on targets. And if nothing else, I think the policymakers or the regulator may do well to say that whoever you are, whichever fintech or entity you were working with, which was digital, if last month or in the month of Feb you did X, we want you to do X plus, and give a naturally positive target so that more happens and not less happens. Just because physically we are at home and we just discussed this is a digital industry, there's no need for people to be physically present together. There's no reason for people to be doing less. While our banking seems to be now doing less for a variety of reasons. So we have to do more. This is time to do more, as much as we are expecting our health workers to fight it out for us and make sure that we are safe and healthy. It is for our banking financial industry to do more and make sure the economy comes back once this physical disruption is over.
Okay. So thanks, Manish, for joining us and giving us deep insights on the SME business and how it will come back. So thanks, Manish. Thank you.
Thank you, Samir. Pleasure.